Bismillahirrahmanirrahim. In the previous class, we were discussing about management assertions and audit objectives. We discussed about management assertions, that management assertions are basically the claims of the management regarding the financial statements. Like, suppose I am making a financial statement, so I am claiming that this financial statement is free from error and fraud, and I followed the generally accepted accounting principles or international financial reporting standards in these financial statements. So this is basically management assertions, that the financial statements made by the management, these financial statements are free from errors and frauds, and we followed the international financial reporting standards are generally accepted accounting principles, and the all the items in the balance sheet, all the items in the income statement, these items are recorded because these items relates to the entity, and there is evidence of each and every transaction. So this is basically management assertion. Then we discussed about three kinds of assertions. One assertion was about classes of transactions and events for the period under audit. We discussed about this, assertions about classes of transactions and events for the period under audit. We discussed about occurrence, we discussed about completeness, we discussed about accuracy, we discussed about cut off, and then we discussed about classification. So we discussed about the assertions of the management regarding the transactions and events for the period under audit. Like, one assertion was transactions and events that have been recorded have occurred and pertain to the entity. All those transactions and events that we recorded, that have been recorded in our financial record, these relates to the entity. We didn't pick this from our mind. These are basically the transactions of the entity. Similarly, we discussed about all these. Today, we are going to start the second kind of assertion, that is assertions about account balances at the period end. All the balances, account balances, that is asset, that is liability, that is equity accounts, revenues, expenses, all these balances. So we made some assertions about all these account balances at the period end. Like, the first one is existence, that all these balances, these exists, the balances of assets, the balances of liabilities, and the balances of equity interests exist. Means all these things are available with us. All the balances of assets, all the balances of liabilities, and all the balances of owner's equity, these relates to the organization, these relates to the company, and there is evidence and there is proof of all these things. If there is asset, so for asset, what is the evidence? I told you, you have documents of land, documents of building, and these things. Liabilities, so for when you're taking some liability, so you're making an agreement. So there will be a copy of the agreement with the bank and other things. And owner's equity, so when you issue shares, somebody is investing money in your company, so there will be some evidence of that thing as well. So all these balances exists. There is no fake item in our financial record. So all these balances exists. Then, so this is our first claim. This is the first claim of management, that all balances, these balances exists, and these balances relates to the entity. The second assertion of the management is rights and obligations. What does it mean? An entity holds or controls the rights to the assets, and liabilities are the obligations of the entity. Keep in mind, all assets, you have rights of that assets, and all obligations, all liabilities, you have obligations, you have responsibility to repay these liabilities. Take an example. Suppose this is a piece of land. We mention it in our balance sheet. This is suppose balance sheet. So we mention land. Amount is $5 million. So we mention this thing in the balance sheet, that this land, this is a piece of land, and this piece of land belongs to this entity. Keep in mind, when you mention something in balance sheet, this thing relates to the entity, and when this thing relates to the entity, you have the right to use it, right? Haq. You can use it. All the assets in the balance sheet, you have a right on that. And what does right means? Right means you can use it. Right of what? Right to use something. So you have right on all the things, all the assets mentioned in the balance sheet. Suppose there is another thing, building. Suppose there is another thing, machinery. Suppose there is another thing, cash. Suppose there is another thing, inventory. So these are the assets, all the assets. And when you mention these things in the balance sheet, so it means that you have the rights, you have documents, you have evidence that this thing belongs to the entity, and we have right to use these assets. Listen again. I mentioned all these assets in the balance sheet. These are the assets. So when you mentioned, so it means that you have right on these things. Right of what? Right to use these assets. And for using, you can use something when you have evidence that these things belongs to you. So evidence is what? Evidence is documents. Documents of your land, documents of your building, documents of your machinery, and all these things. So you have evidence of these things, that these things belongs to the entity, and I have right to use these assets. So this is another assertion of the management. All the things in the balance sheet I have right to use these things. And about the liabilities, liabilities are the obligations, and liabilities are the obligations of the entity. And all the in the balance sheet there is another column of liabilities. So all the liabilities, these are basically my obligations, and I will repay these obligations. Liability 1, liability 2, liability 3, and all these things. So you will repay all these liabilities, and these liabilities are the obligations of the entity. And for proving these things, that these are my obligations, you have some documents. So the second assertion is about the rights and obligations about all these account balances. The third thing is completeness. The third assertion of the management is completeness. All assets, liabilities, and equity interests that should have been recorded have been recorded. Whatever needs to be recorded, we record it. Nothing is missing. Each and everything is recorded in the balance sheet regarding assets, liabilities, and owner's equity. Nothing is missing. We completely record all the balances of assets, liabilities, and owner's equity, and nothing is missing. This is another assertion of the management regarding the account balances, that each and everything is recorded completely. We record each and everything and nothing is missing. Then there is another assertion, valuation and allocation. What does it mean? Assets, liabilities, and equity interests are included in the financial statements at appropriate amounts, and any resulting valuation or allocation adjustments are appropriately recorded. This thing is basically concerned about the valuation of assets and allocation, that whatever we record it properly. Suppose this is machinery. We purchased it 10 years ago. What was the cost? Suppose it was $1 million. Now, below this, we are writing cost less. Here we are mentioning depreciation, accumulated depreciation. So if you will record it at 1 million, it is not proper recording. Why? After 10 years, this machinery is depreciated. So what is the depreciation? We already shown that thing here, that from 1 million we deduct 4 lakh accumulated depreciation. So what is left? 6 lakh is left. So 6 lakh is basically the actual value of this asset. So the allocation, this is basically valuation. We properly valuate this asset. So valuation and allocation means asset, liabilities, and equity interests are included in the financial statement. We include it in the financial statement at appropriate amounts, at their exact amounts. And any resulting valuation or allocation adjustments are appropriately recorded. And whatever adjustments need to be done, we did that adjustment, just like I told you here, that what is the value of my machinery when I purchased it? It was 1 million. But after 10 years, this asset is depreciated by 4 lakh. So from 1 lakh, when I deduct 4 lakh, whatever is left, 6 lakh. So it is the proper valuation of this asset. This is, we made adjustments to all these accounts and we record it at proper value. Same is the case of building, same is the case of inventory. In an inventory, there is a specific rule, so we will follow that rule. So for valuation of all these assets, I properly record it. Now suppose the value of land, it was 5 million when I purchased it. Today its value is 10 million, but you can't record it at 10 million because there is a principle. We call it historical cost principle. According to historical cost principle, all assets will be recorded at their historical cost, at the cost at which you purchase it. So we purchase it at 5 million. So you will record it at 5 million in the balance sheet. You will not record today's value of 10 million. So this is the principle. So we properly valuate the assets. We properly made adjustments to all these assets. So this is basically valuation and allocation. So these are the assertions about the account balances at the period end. All the balances of assets, liabilities, equity and other things. These exists. We have rights and obligations regarding these things. We can use it, and liabilities, we will pay these liabilities. Completeness, we completely record all these things and nothing is missing. And valuation and allocation, we properly evaluate it and we properly made adjustments to these assets, liabilities and equity accounts. Whatever adjustments needs to be done, we did that thing. So this is basically assertions about account balances at the period end. Then the third assertion of management. Assertions about presentation and disclosure. I told you about disclosure. That disclosure means all the important events. This is my financial statement. So below this financial statements, all the important events are disclosed properly. If some important events happens, so I properly disclose it below the balance sheet or below the income statement, and I give proper notes so that the users of financial statements can easily understand this financial statement. So we call it disclosure. So now here are some assertions regarding the presentation and disclosure of these important events. Sorry. Now, the first assertion is about occurrence and rights and obligations. Disclosed events, transactions, and other matters have occurred and pertain to the entity. All the disclosed information, all the disclosed events, transactions, and other important events have occurred and pertain to the entity. I mentioned that these are the disclosures. regarding the important events, transactions, whatever happens, I disclosed it. And these things relates to this company. Suppose this company name is Facebook. So these relates to this Facebook. These events relates to the Facebook. These important events. So this is the first assertion that all these events, these relates to the entity. These important events, these important disclosed events, these events relates to pertain to this entity. Completeness. All disclosures that should have been included in the financial statements have been included. I include the management. He is making an assertion that whatever is important, I completely mentioned it in the disclosure. Nothing important is left. I told you one thing, that here in the disclosure, this is disclosure. I'm writing shortly, this is disclosure. Now in this disclosure, each and every important event is disclosed and nothing is missing. This is another assertion of the management regarding the important events, that important events are properly and completely disclosed, have been included. Classification and understandability. There is another assumption. Financial information is appropriately presented, properly we present it and described, and disclosures are clearly expressed. Whatever is expressed here, it is clear. There is no cheating in this. Like some people, what are they doing? When they are writing a sentence, so in that sentence, they are trying to hide something. When you will look at that sentence, it will look in one way. But when I will study that thing, it will look to me, it will give me some other meaning. So, but the events that are disclosed, it is clear. See, understandability. Each and everything can easily understand. I properly classify it, and each and every person can easily understand these disclosures. Financial information is appropriately presented and described. Properly we present it and properly we described it, and disclosures are clearly expressed, and we clearly express these events. Each and every person can easily understand these disclosed events. Accuracy and valuation. Financial and other information are disclosed fairly and at appropriate amounts, and these disclosed events are recorded accurately, the first thing, and the second thing is we record it at appropriate amounts. So the last assertion regarding the presentation and disclosure is the accuracy of these disclosed events, that these disclosed events are accurately recorded, and the second thing is we evaluate it at appropriate amounts. So these are the assertions of management. Three assertions. One is about classes of transactions and events. The management has claims regarding transactions and events. Management has claims about the account balances, the balances of assets, liabilities, and owner's equity. And the management has claims about the presentation and disclosed, all the disclosed events, their presentation. So, management has claims about these presentations. Now, what will auditor do? When auditor will come, you claim, the claim of the management is regarding, these are the main three claims of the management. Now when auditor will come, he will check your claims, that your claims are true or your claims are false. I think for today it is enough. Inshallah, in the next class, then we will talk about audit program, its advantages and disadvantages. Now, one thing, if you are, if there is some problem in this video, so you can, if there is some question, so you can ask about these questions in the WhatsApp group. Okay, have a good time.